Since July 2007, the government made pretty major changes to the superannuation system, particularly for those people who are 60 years of age and over. And effectively what the government has done is this. They've said, look, if you're in a superannuation fund and you are earning income, you can take money out of that fund on a tax-free, tax-exempt basis. Now, how much you can take out is a function of a couple of issues. Firstly, whether you are working or have retired or have gone back to work. Now, these issues can get a little bit complex, but to keep it simple, if you're 60 or more and you're working, then generally speaking, you should be able to take at least up to 10% out of your superannuation fund per annum on a tax-free, tax-exempt basis. Tax-free means you don't pay tax. Tax-exempt means it doesn't even turn up on your tax return or any part of your income tax statement, so it shouldn't have any impact on other types of benefits that you may be receiving. It simply just doesn't appear. The importance of this is it means effectively you can take money out of your super fund, pay no tax on it. Now, you may not need the money because you're working. You've got an income that you're quite comfortable with. It's paying all your bills. In fact, you may have a surplus and may already be putting money into super or undertaking a saving strategy. The significance of it is that if you receive money on a tax-free basis, you can now put more money into superannuation on a tax-deductible basis. And this is where the concept of these, what are generally referred to as non-commutable pension income streams, is really very, very useful. A taxpayer basically takes out, say, $20,000 a year out of their super fund on a tax-free basis, can then pretty much approach their employer and say, look, I don't need to earn anywhere as much as I used to because I'm taking money out of my super fund. Can you please now salary package $20,000 or more, depending on cash flow and related issues, back into my superannuation fund? Now, this then converts your so-called tax-free money from the fund into a tax-deductible reduced wage. When I say tax-deductible reduced wage, what I'm really saying is that if you don't earn a wage, you don't pay tax on it. If it goes direct to your fund, you don't pay tax on it. Now, it is true the super fund will pay 15% contribution tax on that money, but for most people that's far less than the marginal tax rate that they'll be paying on their personal income. So effectively, what these income streams do is allow you to make tax-deductible contributions to super. Another important part of this process is you shouldn't overlook the importance of reducing your so-called taxable income and the effect it has on giving you access to other benefits. For example, there is a low income rebate that can sometimes be accessible if your taxable contributions to super reduce your wage, because you're seen to be earning less, therefore you qualify for rebates. There's a mature age allowance that is also triggered if your earnings are below a certain level. There's also what is referred to as the co-contribution scheme, where if you're earning below a certain level or at a certain level, you can put private money into a super fund and receive a government top-up. Now, for a lot of people, these things are not available because they're earning too much money. But in terms of the ability to package super, you can reduce your income and you can qualify. One of the main reasons that people don't package superannuation, and it's quite a reasonable one, is that often the money's not there. It's all very nice to say pay a lot of money into superannuation. The money's not there because you need it for day-to-day living expenses, you can't pay it. And that is the norm. You know, not everyone, and it's quite common, has all this surplus money lying around in order to salary package large amounts into super. And again, this highlights the significance and the importance of the so-called non-commutable pension income stream. It gives you a source of money that then allows you to pay a lot more into super than ordinarily you would have done. And effectively, this is the key strategy behind this sort of contribution process. For further information, most super funds will provide this with you. The information I'm giving here is general advice, not investment advice. So you need to be very careful about how these things are structured. But from a taxation perspective, in terms of purely saving on tax and accessing rebates, this sort of strategy is extremely useful. If you're over 60, it is almost a must. You should be doing it, and you should be getting advice about how you can implement it. It is possible to be implemented for people that are between ages 55 and 59. It's not as effective at that age, but it still works. Gets a little more complex. once again, get some professional advice and have a look at how these mechanisms can save you tax. Thank you.